The following was recorded in front of a live studio audience at the Studio 21 Podcast Cafe. This is the United Podcast Network.
Welcome to Tell Us Why, a podcast for the financial freedom community. If you're looking to succeed in your quest for financial freedom, make sure you join us every week as we, along with our guests, discuss different stories of success, how they were achieved, and how you can do the same. And of course, we ask them to tell us why. Here are your hosts, Jack and Mike.
Welcome to the Tell Us Why podcast. I am your host, Jack Dalrymple, here alongside my co-host, Michael Ketchen. Today, as part of the Financial Freedom Series, we will be talking about leverage.
Oh, my favorite topic.
What is leverage? Is it good? Is it bad? Should you be using leverage in your business? You want to hop right into it?
Yeah, I think we should get right after it. For those who are seeing, this is the third part of the series. We've talked about assets and liabilities. We've talked about good debt versus bad debt. And today we're talking about, in my opinion, what is the most important thing to understand as you're scaling your real estate business, or really most businesses, to be honest, is leverage. And I'll start off with the example like I tell Jack the way I look at it. And it ties into the good debt, bad debt, ties into assets versus liabilities. When it comes to leverage, let's say you have 100 units spread across 4 apartment buildings. You have 100 units that are indebted to you, and they're spread across 4 buildings. So you're indebted to the mortgages on those 4 buildings.
You can let Nancy in if you want.
So we're going from there, and essentially you're now leveraged 25 to 1 or 4 to 1, depending on how you want to look at it. But essentially that leverage allows you to scale. It allows you to essentially access massive amounts of good debt, which can then directly correlate with your lifestyle and your debt pay down and assets versus liabilities. It all kind of ties together what you're seeing. But yeah, let's get into leverage and let's talk about using this in investing and throughout our different businesses.
Are you sick of being treated like just another number by large insurance companies? Do you want a more personalized experience with somebody that you can trust? With Keith Monteith, that's exactly what you'll get. Keith is an experienced professional who can design an insurance plan tailored to fit your specific needs. With access to over 30 insurance carriers, Keith is able to shop numerous markets to find a price that works for you. So if you want an insurance agent that you can rely on and one that has your best interests at heart, then call or text Keith today on 978-241-2363. That's 978-241-2363. Keith Monty. He'll get you covered.
All right. Like I mentioned, we will be talking about leverage today and as part of the Financial Freedom Series. And the problem with most people who want to get rich quick is that they're trying to build the Empire State Building on a 6-inch slab of concrete. They haven't gone deep. They don't have a firm financial education to shore up their financial foundation. So last episode, we talked about good debt. What is good debt? I think the general definition of good debt is low interest debt that helps you increase your income or net worth would be an example of good debt, right?
Yeah, I think so.
And bad debt, expensive debts that drag down your financial situation are considered bad debt. They include debts with higher variable interest rates, especially when you use for like discretionary bullshit expenses, as we kind of alluded to in that one. But
liabilities.
basically, yeah, things that lose value,
Yeah,
exactly.
exactly.
So I think the main takeaway from that episode was Dave Ramsey's advice is absolute dog shit.
I agree.
Okay.
I concur.
Perfect.
So there we go. Button that up. So looking at leverage, I think you just hit the nail on the head right there, right? So in a typical real estate deal, I go to you. Let's talk real quick about some ways you use leverage in some of the deals you've secured. Why don't we explain what we mean by that?
Well, I mean, first off, I was able to buy $1 million asset for not investing $1 million.
Yep.
Imagine that. Now I make tens of thousands of dollars on a monthly basis because I used leverage.
Use leverage. Okay, and how did you use leverage on that deal?
A bank.
A bank. So with debt, look at that, good debt. So to Jack's point, one thing we do as real estate investors, and there's multiple layers to this, but on its most simplistic level, is you secure an asset, and it's usually going to be anywhere from as little as 3.5% down. Technically, you can even go as little as 0 down, up to sometimes 20, 30, 40, 50% down, depending on the size of it, depending on who's collateralizing it, depending on where the debt has come from.
I mean, you can go as high as you want.
Yeah, you can go basically any LTV you want. And as that asset continues to get paid down and you're paying off that debt, your leverage is decreasing, but you use the initial amount of leverage to secure the asset. And now, so that debt's being paid down by the tenants, it's spitting off cash flow, you're getting the tax benefits, you're getting the debt paid down, you're getting the appreciation, on and on and on. However, the thing you said that was the key takeaway right there in the beginning was leverage, because you could not buy. You didn't come to the bank with $1 million to secure the asset. You came with probably 10, 15, 20%, whatever it might have been.
Yep.
And you might even involve some partners
Absolutely.
to bring in some additional capital to secure a larger asset using leverage.
Absolutely. But let's step back for a minute and just define leverage, the textbook definition.
Let's do it.
So leverage refers to the use of debt, borrowed funds, to amplify returns from an investment or project. Investors use leverage to multiply their buying power in the market. And then on the business front, companies use leverage to finance their assets. So for example, like a Fortune 500 company, they would instead of issuing stock to raise capital, they can use debt to invest in business operations in an attempt to increase shareholder value, or in the small business issue debt to not dilute their
earnings or their
equity.
Their equity. Okay.
Yeah.
So staying with that lens, for example, if we're talking about leverage and businesses are doing this, is it always good, or can leverage go sideways sometimes?
Oh, I mean, leverage is by definition a riskier than paying for something straight cash. If you have cash and you pay for whatever, a stock, a bond, a house, a business,
See, and I was gonna say, I'm gonna challenge you on that, because if you are, if you're using leverage, to your point right there, right?
Yeah.
And you say it's riskier. What I believe and what I've built my entire real estate portfolio on is creative finance, and we have a certain model where we buy a deal. I don't want to geek out too much because we'll do this in the webinar, but essentially, I buy deals with enough meat on the bone in my criteria that I'm accounting for basically being a high leverage on acquisition to then reposition the asset out of that high leverage and be able to basically pay off all that leverage and be left with the asset.
Yep.
So you were going to say it's risky, I always come from the standpoint of putting all your cash in one deal, to me, is riskier, because now you've basically emptied out your cash reserves. And now if the market tanks, you're upside down, whatever it might be, you're left in a worse position, in my opinion.
Yeah, absolutely. I mean,
It may not be the popular opinion, but it's my opinion.
The textbook definition implies that being levered is risky. But again, going back to the real estate example, and I've done it with stocks and bonds and things like that too. I guess that's technically margin. Maybe doesn't qualify as leverage, but
same kind of concept.
It's the same concept. It doesn't technically qualify as leverage, but it is leverage. Like I've levered. Every asset that I've ever purchased has been levered. Like I couldn't have expanded my portfolio had I not leveraged the asset. But I'm also not buying $1 million properties for $1.2 million. Like that would be an excessive amount of leverage. So if the market goes down 20%, then I'm screwed, because now it's an $800,000 asset that I paid $1.2 million for, and now I'm in the hole $400,000. Like that's risky. I'm buying $500,000. I'm paying $500,000 for $1 million asset. So even if it tanks 50%, I'm still in the black. Like I'm not bleeding on a monthly basis. Like, again, you're gonna go with cash flow and what your monthly loan payments are. But as long as you're not bleeding assets and you're not in the red in terms of an asset value standpoint, I mean, like everyone in real estate always says, you make the money on the buy.
Absolutely.
So.
Absolutely. And to that exact point, where leverage can get out of control and where this can become dangerous is if you're just out there buying, like we talked about way back on the assets liabilities, the first part of this financial freedom series. And to Jack's point, where you make your money in the buy, if you're just buying basically retail and you don't have an exit strategy in mind to force a massive amount of appreciation, or it's not some kind of a complicated tax play, whatever it might be, you're just paying retail for a property, you're not investing at that point. You're basically just parking money somewhere and hoping for the best. And what do we always say? Hope is not a fucking plan. And what Jack just said is perfect when it comes back to leverage. If you're buying something, paying retail, and then the market shifts, you can quickly be upside down. That's what happened in 2008. That's what there's some fear out there right now, with these inflated asset prices where things are going 10, 15, 20, 25% over what they were, being bought for just a year ago. That makes me nervous right now, because if the rents and the cash flow doesn't continue to accelerate to support the debt, you can be upside down in your acquisition price. And that's where leverage can bite you. It can become addicted to just, don't do deals just to do deals. Don't leverage just to leverage.
I feel like a lot of people in the market at this point are doing that, doing deals just to do deals. They're not making the cash flow that they should be making that justify, especially in the multifamily space. I mean, single family is a little different, but the cash flow to justify the price that they're paying.
Yeah.
And it's a little reckless. But again, on that front, I don't think the multifamily or even single family space is going to see '08 is an anomaly. That's not going to happen again. We're not in that situation. But there's still a housing shortage. In the next, as the millennials age to, I think the home buying, that article that I sent to the investor discussion the other day, the average age that individuals buy a home, I think, is now 33, might be 35 years old, something of that nature. There's going to be 4.1 million new people maturing to that age that are going to need to buy houses, or that potentially will buy houses. The problem with that right now is there's already a 5.1 million shortage of houses in the United States right now. So over the next, I think it was 3 or 5 years, there's going to be a $9 million unit housing shortage at that point.
Yep.
So I don't feel like being levered right now is a bad or risky endeavor. Although for my leverage, I'm going to be unlevered within the next, for all of my assets, I'll be unlevered within the next 12 months anyway. So I'll probably pick up some more assets. But again, it's going to come down to the buy.
Well, and again, play devil's advocate right there, though, too. You're going in with a very clear exit strategy. You're getting into the underwriting model where you can stress test these deals. What we're seeing a lot of times, because I really want to point out before we sing all the praises on leverage, some of the bad sides and where people can get in trouble with this is if you're essentially paying a premium for an older asset, or you're buying a business where the books might be a little fudged, or maybe that building had a huge spike, that business had a huge spike during COVID, and it's actually not sustainable as things scale back, or you're basically just not as thorough in your due diligence, and you're borrowing money to secure that business, secure that asset, start that endeavor, whatever it might be. If you are not going into it and being thorough for the worst case scenario, basically, if that business or that asset can't survive the worst case realistic scenario, I would pass. And that's where you have to be careful, because basically, essentially, once I'm borrowing something to secure something else, I am now indebted. And a lot of these loans, a lot of things that involve leverage require a personal guarantee. And where that can get very serious is, just like your mortgage, these are personally guaranteed things. If you go sideways, you are on the hook for that. That can lead to bankruptcy. That can destroy your credit for 7 years. That can come after other assets. You can really put yourself in a bad position. So I'm so conscious to people. I think people think we're very aggressive with Commonwealth Collective with the number of deals we do, when in reality, we're actually very conservative. We're just looking at so much, and we've defined our model so clearly that when something does fit our model, we move very fast, because we've already identified. I mean, every deal I have, you've seen the numbers we do. That's why they're so hard to find. I could take a 20, 25, probably even a 30% rental correction and still be able to pay ourselves, pay our bills, and pay our debts. That's very hard to do in this market right now where things are hyperinflated. So now I see people continue to buy these same assets at the same rents I'm getting, 30, 40, 50, 60% lower on the purchase price. Plus, they're not budgeted to then make the repairs necessary to sustain the asset. And then they're levered up 80, 90, 95%.
Yeah.
It could potentially lead to a world of pain. And that's why we talk about where debt and leverage can be addicting, and you have to be very careful to that.
Yeah, I mean, one of the things that I like about the multifamily space is that rents are generally very illiquid. Mm-hmm. And by illiquidity, I mean that they don't tend to move negatively very much or very often. Historically, rents, it's been a pretty, what way looking? This way? Let's look this way? That's a good way, right? I mean, historically, they've gone up at a consistent pace over time.
Yeah.
This way, over time.
Oh, my goodness.
So, and the multifamily asset is valued based on the rents that it demands. So even if there was a housing correction, it may not affect the multifamily space as much as the single family space.
So
but in other terms, like in business, like a business, if you're leveraging, so say it's February or January of 2020, you're buying a restaurant. You take a small business loan to start this restaurant, and then COVID happens. I mean, that is obviously an extreme example. It's only happened during the Spanish flu, maybe. I'm not sure. So I don't know how many times it's happened, but it's an anomaly. It's a once in a 100-year event where now you're on the hook, you're personally guaranteed, and you have a small business loan for that restaurant that you're liable for.
And yet you can't open.
Yeah, you can't open. The government isn't allowing you to open. You're in a tough situation. So that's a situation where leverage can come back to bite you in the ass.
Yeah, whereas if you had bought it cash, you wouldn't necessarily be in that position. And again, that's why we want to point out some of the bad side. I was going to say some of the good ways to use leverage. Why don't we touch on that real quick? Because I know there's a lot of good ways to utilize leverage. And one of my favorite strategies is basically the equity in homes. And this is a very controversial thing. There are some people who think we're nuts for this. That's fine. To each his own. Everyone's model. The home equity line of credit is one you've heard us reference throughout this series, and we'll continue to use that. Essentially, when you can't touch the equity in your home, it's essentially trapped there. So it's positive, it's helping your net worth, but you're not putting it to work. Meanwhile, inflation is happening, your dollars are eroding. So what a home equity line of credit or a HELOC allows you to do is to tap into that equity relatively cheap, leverage that to get into other investments, whether it be secure another property, start a business, lend out on a business loan, a million different things you can do with that to tap into that. That's a good example, in my opinion, of if they're giving you the HELOC at, say, 5% and you're getting a 12% return, you're making a 7% spread on that money, and you're putting that money to work.
That's an arbitrage play.
Yeah.
I mean, it's basic real estate arbitrage. You're paying 5%, you're making 12%, you're 7% in the red. Like,
in the black, you mean?
Oh, the black.
Yeah, the black.
Well,
I was like, wow, why is it red?
The green and the black, yeah.
You confused me
not
for
the
a
red,
second
not
there.
the red, the good side.
Yeah.
So, yeah, I mean.
So, I think that's a great example, and we'll talk throughout the community about some other examples of leverage, but that's definitely my favorite. I don't know if you have anything to add on that.
I mean, I got a negative example that I've experienced in my life.
Ooh, give the
Again,
negative.
it goes back to margin, but I have a play that I love in the stock market. I haven't told anyone about it. I'm not going to tell you now. But it came back to bite me once in like 2018, I think. I had a margin investment on margin, and I got margin called on it, and I was fucked.
That was not good.
It was not good at all. And I mean, that's an extreme example where the price went. It was a short play. Price went up, I think, like 50% in a day, and I got hammered, absolutely hammered. So I had to come up with that money. I was levered on that hardcore. Actually, I think it was more earlier than 2018. I think it was like 2015, but I got bid on it bad. And it took me a while to come back from that. Gotcha. So, I mean, there are extreme examples. That is an extreme example of where you can get bit.
So would you say the big takeaway is be very careful with leverage, use it when needed, and basically make sure you thoroughly evaluate, but don't be afraid of it either.
Yeah, I mean, leverage isn't a bad thing by definition. Like, I think people tend to avoid, again, going back to Dave Ramsey and debt, thinks leverage is awful. It's the worst possible thing you can do. I fundamentally disagree with it, and it helped me achieve my wealth.
And your financial freedom.
And my financial freedom, absolutely.
I like it. So wrapping this up, where can they find us on social media?
You can find us on YouTube, Facebook, Instagram, LinkedIn, Twitter, basically every platform there is. Everything. Our podcast is available on all platforms now, so
we are everywhere.
Everywhere.
Leave a rating and review, please.
Yeah,
also,
absolutely. Like it.
Check out the swag shop. As always, you can get the swag, the Bet on Yourself, the Aspiring One Percenter. And if you want to check out an episode of the Tell Us Why podcast, come join us at the Studio 21 Podcast Cafe here in Salem. We record every Wednesday.
And that's it for today. Please be sure to join us on next week's episode. And until next week,
bet on yourself.
The views and opinions expressed by the hosts, guests, or callers of this program do not necessarily reflect the opinions of the Studio 21 Podcast Cafe, the United Podcast Network, its partners, or affiliates.